Welcome everybody to our episode 15 in our series of write-offs for real estate investors. Bernard and I are going to address today a very common question about how LLCs and business entities help real estate investors. And Bernard, I will use the most common phrase, or actually two, that my clients use. They either start the sentence by saying is, I've been told, or according to my research. So I've been told, or according to my research, once I create an LLC, I have more deductions and less taxes. Can you elaborate on that, Bernard?
I'll be glad to. Unfortunately, there's not that much to say. It's really very brief. An LLC in and of itself does not create any tax deductions other than for the cost of forming the LLC, potentially.
Okay, then why people create LLCs?
Well, there's why people create LLCs, and then there's why should people create LLCs. And I think I'll move on to the next slide. People do often create LLCs because they're under the impression that it's going to create tax deductions. We know that's not the case. However, there are very good reasons to create an LLC, and that is for legal benefits. LLCs do create asset protection benefits. Now, we're not discouraging folks from creating LLCs. In fact, we think nearly all real estate investors should form LLCs. However, they should form them for the right reasons. And when they form them for the right reasons, that will help them form them at the right time, in the right domicile, and get the right benefits, and not pursue tax benefits that LLCs don't create.
So when Bernard talks about right reasons, when I talk to my clients, I say that there are three different reasons to create an LLC. Okay, there could be more, but there are three main reasons. LLCs for tax reasons. We already talked about that. Both of us mentioned this. LLCs for tax reasons is a no. There are no tax reasons to create an LLC. Second one, Bernard just talked about, is legal reasons, is for legal protection. And third reason is if you are doing business with other people, you may need to have an LLC in order to structure your relationship. So we talked about, I will comment again about all three of them, but from a slightly different angle. So first we said no tax benefits. And some of you right now are waving your hands and saying, wait a second, I've been told, or according to my research, S corporations have huge tax benefits. Okay, we are going to talk about S corporations, but not today. Our next episode will specifically discuss S corporations. So today we are only talking about LLCs and entities that are not S corporations. And those entities, normally, if you have an LLC that you create for yourself, or you create an LLC for husband and wife situation, those LLCs normally are called disregarded entities.
And that's in a community property state.
I'm going there. Okay, in fact, I'll let you go there. Okay, but let me finish that by saying this is one of the very rare instances when the IRS term actually means exactly what it sounds. Disregarded means is he does not care. As far as he is concerned, whether you have LLC or not have an LLC, everything is the same. The tax return is the same. The tax liability is the same. And I said, when does it happen? It happens when you have a one person or when you have husband and wife, with an asterisk that Bernard correctly added, and that is
community property. So some states are community property states, which is
Like my
primarily
wonderful state of Texas.
yes, and that's why that's kind of where you default to saying that husband and wife are disregarded. I'm in the Northeast where we don't really have community property. So community property states, now community property is primarily a legal concept, but the IRS does recognize it for LLC purposes.
So what
So
happens when you form husband and wife LLC in one of the unfortunate states where you live?
Well, it's an automatic partnership, and that is very important because people sometimes are under the impression that if they form something together with a spouse and they're married filing jointly, that it's going to be disregarded. It is not the case. There's something else, and I don't know, Michael, I think we were going to take this off the agenda, but there are qualified joint ventures between spouses. Again, if you form an LLC, that does not apply in a non-community property state. Two spouses have an LLC that forms a partnership for tax purposes, which means they now have to do an annual Form 1065 with the IRS and potentially a state partnership filing as well. In contrast, in a community property state, being that for most marital laws and legal purposes, it's viewed any property that's created within the marriage or brought into the marriage is potentially community property, which means these two spouses are viewed as owning it as a unit. The IRS is ready to apply the same treatment to a husband-wife LLC formed in a community property state. So if you form an LLC in community property state with your spouse, you have a choice. The IRS actually gives you an option and says, tell us how you intend for this to be treated. Is it going to be treated as a disregarded entity or treated as a partnership? And in most cases, you probably want it to be disregarded to avoid the hassle of dealing with a tax partnership.
Okay, so to close that close conversation about the first reason tax benefits, let's review it to be very clear what happens. So if you form an LLC for one person only, that LLC is disregarded, does not exist for Uncle Sam. If you form in any state, does not matter where you are. Next is, if you form an LLC with your spouse, then the answer depends on whether you form it in the state which is a community property state, which there are several of those states, or non-community property state. Community property state, it's usually disregarded again, no complications.
I would just throw in, just to the verbiage a little, it depends on primarily where you reside more so than where it's formed.
Correct, correct. Yes, very good correction. Okay, and if you are forming a husband-wife LLC in a non-community property state, then the IRS says that is a partnership. Why is that important? Because now you have to file a partnership tax return, incur additional cost of preparing the tax return, which could be significant. And third situation is if you form an LLC with a person who is not your spouse, if you form it with your parent, if you form it with your brother, if you form it with your friend, if you form it with your enemy, if you form it with your friend who becomes your enemy after you formed an LLC. So in all of those cases, this is a partnership. Partnerships are complicated for compliance, complicated for tax filing, and incur costs. In addition to costs of tax preparation and compliance, there could be costs imposed by states. Give us a couple examples of what they are.
Yes. So this is, when it comes to LLCs, what's important to understand is we've moved away from federal law and we've moved into state law. LLCs are creatures of the state in which they're formed. And we've got 50 states. We've also got DC. So we really, even within the United States, we have 51 sets of LLC laws. There's a lot of overlap between them. but there are important distinctions. Additionally, states can also tax LLCs differently. And I think a good state to use
is Texas.
Let's use Texas. Okay. So Texas is a state in which when you form an LLC, you have to deal with two things. You actually have to deal with the Secretary of State in Texas. You also have to deal with the Texas Franchise Tax Board. Now, they're not so bad. Franchise Tax Board, if you're a smaller business entity, they're fairly reasonable, but you have to know that you're dealing with both of those. So an LLC.
Sorry for interrupt, Bernard, but we were talking about costs. So most importantly is in our great state of Texas, there is no annual fee. You pay $300 to form an LLC, and then there is no annual fee, which is in sharp contrast to not so wonderful state of.
Well, I'll do that. I want to provide a little bit of introduction, if we can, to Texas a drop. In Texas, though, there is an annual filing. Now, who is that with? That is not with the Secretary of State, with which whom you form the LLC. It's with the Franchise Tax Board, and typically you file a no tax due report. Let's jump into California, which is, I'm guessing, where you were headed with this.
Let's not.
Yeah, let's stay at California. They make it difficult. So in California, believe it or not, when you form an LLC, it's $70, less than Texas. Can you believe that? The California Secretary of State is very reasonable, and they only want the only annual filing that the Secretary of State wants is $20, and it's an information report with some basic details. But the California Franchise Tax Board is not reasonable, very unreasonable, and they apply a minimum annual tax of $800. So if you have an LLC that is either registered with the state of California or is in some way doing business in California, even if it's registered in Texas, the state of California wants $800 per year. And that's not the Secretary of State, it's their Franchise Tax Board. So California and Texas do have that in common, that LLCs are subject to regulation, to compliance by both the Secretary of State and the state taxing authorities, except that in California, we're looking at a minimum of $800, and it goes up from there depending on your annual California source income.
Yes, so basically what happens with California investors is if they reside in California and own property in 5 other states, and they would create one LLC in each of the states where they own properties, they now have, as far as California is concerned, 5 LLCs, each one subject to $800 every single year minimum, and maybe more. And people saying is, but I don't own any properties in California. Now, you live in California, and California considers your LLC subject to $800 per year minimum, no matter where it is. It's definitely a consideration, and each state, as Bernard said, have different rules. So when we talk about execution, our last point is maintenance is very clear, but we put there get entities for the right reasons. Let me remind you, we just talked about these 3 reasons. Third reason, the last one, was if you do business with other people, you will probably need an LLC in order to structure your relationship legally, and that would be a right reason to create an LLC. The first one was tax reasons, and we tried to explain to you that unless you have a husband and wife LLC in non-community property state, those LLC will be disregarded, which means no change in taxes, no good or bad influence on your bottom line. But that middle one is the right reason for legal reasons. Now, neither Bernard nor myself are attorneys. We cannot give you legal advice, but I can give you general common sense advice, which is this. If you talk to 2 attorneys about asset protection, I can guarantee you that these two people will give you conflicting advice on what to do, how to set up LLC. Here is an example. You have 10 properties. Are you going to have one LLC where you are going to put 10 properties? Are you going to have 10 LLCs with one property in per LLC? Are you going to create two LLCs with 5 properties each? Or are you going to create one series LLC which will hold all 10 properties but separated into compartments called series? Or do you not care about LLCs at all? Just buy more insurance and forget about LLCs. Depending which attorney you talk to, you will get all 5 of these opinions, and there are more. So what I always tell my clients is this: when it comes to legal protection, which is the most important reason to create an LLC, is find one attorney who makes sense to you, who you want to work with, who is accessible, personable, competent, affordable, whatever your criteria is, and then sign up for whatever asset protection religion that attorney practices. Never seek a second opinion. That's part of the execution advice that I give, because second opinion on asset protection is going to contradict the first opinion. And if you look then for the third opinion to figure out which one is right, you will just get third opinion that contradicts both first and second. And on that note, I want to close our LLCs and entities episode.
Michael, can I throw something in?
Except remind you that next one is about S corporation, a specific type of entity. Yes, Bernard.
So I would toss in, there's a lot out there, specifically California. And so I'm going to, there are all sorts of things out there on the web, things potentially to sidestep California franchise tax, complex asset protection structures. I would say as what I've seen, a caveat is avoid something that is an entity, avoid entity mills, avoid businesses whose business model is to sell and create entities. If you're looking for tax advice, look for somebody that is not legal advice, somebody that is local and is not primarily generating income by forming entities, but rather primarily by advising. Some of them may be attorney-run firms, but their primary business is creating entities, not providing legal advice. When it comes to legal items, get advice, stay away from entity mills.
Excellent advice. And thank you guys for listening. We'll see you on the next episode about S corporations.
Thank you, Michael. Thank you, everybody. See you in the next episode.